Hi there, it's Friday the 3rd of May 2019. I'm Steve Towers. Welcome to ITV. Let's get started. The Czech Republic has announced that the tax rate for its proposed digital services tax will be an eye-popping 7%, which is much higher than any other country's DST rate so far. The tax will apply to three types of revenue: revenue from online advertising, revenue from the sale of data collected on users of digital interfaces, and revenue from the use of multilateral digital interfaces which allow users to interact and which facilitate the supply of goods or services between users. Only one part of the proposed threshold has been announced: the familiar 750 million euros of global turnover. The second part of the threshold, in regard to the level of Czech Republic turnover, is yet to be announced. The government expects the new tax will start in mid-2020. For a copy of a government statement on the proposed DST, please go to our website or app. Meanwhile, in Poland, the government has stated this week that it will aim to introduce a DST, probably with effect in 2020. No further details have yet been announced. And in Israel, there have been press reports that the government is working on a plan to introduce a DST, with the rate to be set in the 3% to 5% range. There has been no government statement so far. The introduction of economic substance requirements in no or only nominal tax jurisdictions was one of the more remarkable developments in international tax in the last 6 months. Some jurisdictions continue to issue guidance. In this last week, there have been two such instances. Firstly, BVI has released a draft version of the Economic Substance Code, which provides guidance on the economic substance legislation which was enacted in December 2018. And secondly, the governments of Jersey, Guernsey and the Isle of Man have jointly released guidance on the application of their respective economic substance legislation, which is effective from the 1st of January 2019. For a copy of both documents, please go to our website or app. The Tax Justice Network has released a report which accuses British American Tobacco, the UK MNC, of large-scale tax avoidance in low and middle-income countries. For a copy of the report, please go to our website or app. In China, the government has issued a circular which extends the existing rules for accelerated tax depreciation to cover the entire manufacturing sector. This extension has retrospective effect from the 1st of January 2019. For a copy of the circular, please go to our website or app. In India, the GST Council is considering the introduction of electronic invoices in order to reduce GST errors, including fraud. Electronic invoices have been used for this purpose in South America, Korea, and Italy. Under such a system, suppliers would submit their e-invoices in real time to the tax authorities via the GST network, the GST online platform. Only after approval by the tax authorities would the invoices be issued to the customers. Also in India, the Bombay High Court has held that the minimum alternate tax is not applicable to banking companies before the 2013-14 assessment year. For a copy of this decision, please go to our website or app. And the Bombay High Court has decided another case in regard to the royalty definition under both Indian domestic law and the India-Singapore Treaty. The case concerns a Singapore company which operates subscription-based television channels for exhibition of various programs. The Singapore company granted a related Indian company the Indian distribution rights in regard to the TV channels. The Indian company therefore collects subscription charges to enable individual customers to view the channels and pays those charges, less expenses and its own profit margin, to the Singapore company. The tax authorities argued that the payments made to the Singapore company were payments for the use of or the right to use copyright in the programs. However, the court disagreed. It said that the Indian company was granted a distribution right in regard to the TV channels, but it was not granted a right to use copyright. For a copy of this case, please go to our website or app. In Japan, companies are getting ready for the scheduled increase in the consumption tax rate from 8% to 10% on the 1st of October 2019. But with 5 months to go, speculation has started that Prime Minister Abe will postpone the increase. As you know, he's done so before. This will be one to watch. In Nepal, it looks like there's another indirect share transfer capital gains dispute in the mobile phone industry, similar to the Vodafone case in India. This dispute concerns Ncell Private Limited, a Nepalese company which operates a mobile phone network in Nepal. 80% of the shares in Ncell are owned by a company called Reynolds Holdings Limited, which is incorporated in St Kitts and Nevis. Reynolds was a 100% subsidiary of a Norwegian company within the Telia Group, which is headquartered in Sweden. That Norwegian company sold all the shares in Reynolds to Axiata Investments UK Limited, a UK subsidiary of Axiata, which is headquartered in Malaysia. It appears that the Nepalese tax authorities initially pursued the Telia Norwegian company for capital gains tax on the sale of the shares in Reynolds. However, they are now looking to Ncell itself to pay the asserted tax liability. Axiata has stated that it would like to trigger an arbitration process under the Nepal-UK Bilateral Investment Treaty to consider this case. In Austria, the government has announced reductions in the corporate income tax rate. The current rate is 25%. It will be reduced to 23% in 2022 and then further reduced to 21% in 2023. However, there is some uncertainty in regard to the second reduction in 2023 due to the fact that an election must be held by November 2022. In Denmark, the Danish Eastern High Court has decided a case in regard to a claim for refund of dividend withholding tax on dividends received from Danish companies. The claim was made by two investment funds in Luxembourg and the UK. What's particularly interesting about this case is that the High Court appears to carefully sidestep a decision in the same case given by the European Court of Justice. The ECJ decided in 2018 that the Danish rules for refund of dividend withholding tax on dividends received by investment funds breach the free movement of capital principle under EU law because they require that the investment fund be resident in Denmark. However, when the case came back to the High Court in 2019, the High Court decided that the Luxembourg and UK funds were not entitled to a refund, not because of their residency status, but because they did not satisfy the second condition for such refunds under the Danish rules. That second condition is that the fund satisfies the requirements in Article 16C in the Danish tax legislation. And so the court concluded that despite the ECJ's decision, no refund would be given. The European Court of Justice has issued an opinion in regard to the EU-Canada Comprehensive Economic and Trade Agreement, CETA, which was signed in 2016. CETA includes provisions concerning an investment court system, which would involve the formation of a tribunal and an appellate tribunal, and in the longer term, a multilateral investment tribunal. The issue before the court was whether such an investment court system was consistent with EU law. The court decided that yes, it was. For a copy of the court's summary of its decision in this case and a copy of the European Commission's press release, please go to our website or app. The European Court of Justice has also decided a state aid case in regard to a French tax benefit for ports. The European Commission had issued a decision that the French corporate tax exemption for ports constituted impermissible state aid. The decision required France to repeal the tax exemption and impose corporate tax on the ports by the end of 2017. The French government appealed this decision to the ECJ. However, the ECJ has now ruled that the Commission acted correctly. For a copy of this case, please go to our website or app. In Greece, the government has published a bill which will expand the number of services which will qualify for the existing favourable regime for shared services centres. In particular, software development and logistics centre services will now qualify. For a copy of the bill, please go to our website or app. In Italy, a decree has been published which will cause the deferral of the deemed VAT supplier rules for online marketplaces to the 1st of January 2021. However, in their place, there will be a reporting regime for online marketplaces to report transactions by third-party sellers. This regime would require the first report to be filed in July 2019, covering transactions from the 13th of February to the 1st of May. Also in Italy, the decree includes some significant income tax changes, all taxpayer friendly. I'll run through the list. Firstly, the reintroduction of the bonus depreciation regime, under which the tax depreciation base is uplifted by 30% for investments in new tangible assets purchased between the 1st of April 2019 and the 31st of December 2019, with a possible extension to the 30th of June 2020. Secondly, reduced corporate income tax rates on reinvested profits. In place of the standard corporate income tax rate of 24%, a reduced rate will be phased in from 22.5% in 2019 to 20.5% in 2022 to the extent profits are reinvested. And three other changes. Increase in the deductibility percentage for corporate income tax purposes of local real estate tax from the current 40% to 50% in 2019 and then gradually increasing to 70% by 2022. Simplification of the procedures in regard to Italy's patent box regime, and reintroduction of the business combinations bonus, which allows a step up with a limited tax cost for certain assets in business combination transactions concluded by the 31st of December 2022. In Luxembourg, the 2019 budget law has been passed by Parliament. Here are the items I noted. The standard corporate income tax rate is reduced in 2019 from 18% to 17%. This would give an effective rate of 24.94% for Luxembourg City. The threshold for the reduced corporate income tax rate of 15% is increased in 2019 from €25,000 to €175,000. The interest limitation rules, which were introduced in December 2018 in accordance with ATAD 1, are amended to allow the rules to be applied at the level of a fiscal unity. And the VAT rate for electronic books, online news, and other electronic publications is reduced to 3%. And now to Slovakia. You'll remember that in April, the European Commission launched an in-depth state aid investigation into Slovakia's 2.5% turnover tax on the food retail sector. Well, Slovakia has now responded by repealing the tax. As I'm sure you know, the Spanish general election resulted in a big victory for the governing Socialist Party. But, as before, it does not have a majority in its own right in the lower house, and it will therefore need support from other parties. That means that the likelihood of previously proposed tax increases, such as the digital services tax and the financial transaction tax, being passed by Parliament has increased, but they're not assured. And in the UK, some commentators have noted that there will be an interesting VAT change if a no-deal Brexit occurs. UK businesses will be able to claim input tax credits in regard to exempt financial services which are provided to customers in the EU. This change will result from proposed regulations. For a copy of those proposed regulations and their explanatory memorandum, please go to our website or app. The big news in Africa this week is that the African Continental Free Trade Area Agreement has now received the minimum of 22 ratifications from signing countries. It will therefore enter into force on the 30th of May 2019. This free trade agreement is huge. It's been signed by 52 countries, which means that only 3 members of the African Union have yet to sign: Eritrea, Nigeria, and Benin. The agreement initially requires the removal of tariffs from 90% of goods. The UN estimates that it will boost intra-African trade by 52% by 2022. In Zambia, the Tax Appeals Tribunal has decided a transfer pricing case concerning Nestlé Zambia, which acts as a distributor in Zambia of Nestlé products. The background to this case is that Nestlé Zambia had reported tax losses continuously from incorporation and had significant related party payments, purchases of finished goods, royalties, service fees, and interest. There are two interesting points in the tribunal's decision. Firstly, the tribunal agreed with the tax authorities that Nestlé Zambia should be characterized as a low-risk distributor and not as a full-fledged distributor due to the significant amount of control exercised by non-resident related parties. Secondly, the tax authorities said that they could not find any external comparables in Zambia, or indeed the whole of Africa, by which to benchmark the company's results. Also, there were no internal comparables. They therefore used comparables from Western Europe. The tribunal rejected that approach. We do not find the use of businesses in Western Europe to benchmark the appellant to have been proportionate, as the situations of the appellant and those of the businesses in Western Europe are, under the circumstances, incomparable and highly likely to materially affect the transfer price that was being inquired into. Further, it is evident to us that it would be very difficult to reasonably eliminate the potential huge differential arising from the transfer price adjustment. Therefore, it would not be possible to ensure that reasonably accurate adjustments can be made to eliminate the effect of any such difference. The tribunal decided the case by ordering the tax authorities to perform a reassessment. For a copy of this case, please go to our website or app. California has finally adjusted its tax law in response to the US Supreme Court decision in the Wayfair case on the 21st of June 2018. And instead of adopting, as most states have done, the $200,000 or 100 transactions formulation for economic nexus, it has used its own threshold. Under the new law, out-of-state retailers are required to collect and remit California state and local sales and use taxes and district use taxes if, in the preceding or current calendar year, the retailer has total sales of tangible personal property for delivery in California exceeding $500,000. For the purpose of this test, sales into California by persons related to the retailer are attributed to the retailer. In addition, the new California law will require marketplace facilitators to collect and remit tax on sales made through their marketplace effective the 1st of October 2019. And also in the US, more than 80 multinationals have sent a letter to the Senate leadership asking yet again for resolution of the obstruction which has caused new double tax treaties and amending protocols not to be ratified by the US for a long time. For a copy of this letter, please go to our website or app. And now for this week's treaty developments. We've had one treaty signed and one treaty enter into force. I have two articles for you this week. The first article is called The Great Recession and the International Tax Regime. It's written by Reuven Avi-Yonah and it's published in the Kluwer International Tax blog. This article provides an overview of the world's major international tax changes over the last 10 years, and it argues that they all have their source in the 2008 financial crisis. The author writes this: the political reaction to the 2008 financial crisis on both sides of the Atlantic was dramatic. It led directly to Brexit, the election of Donald Trump in the US and of other right-wing populists in the EU, and the prospect of serious limits to globalization in the form of immigration restrictions, tariffs, and the reenactment of exchange controls. The nation-state was reasserting itself, and one of the instruments it used was taxation. In the US, the focus on taxation was limited to the first couple of years after the crisis, since the Republican takeover of the House in 2010 meant that no tax measures could be enacted before 2017. But in Europe, austerity meant a continued political focus on taxing both the rich and MNEs. The result has been a series of developments that led to a significant enhancement in the ability of the international tax regime to capture cross-border income. The second article is called Morgan Stanley Judgment: The Emergence of Transnational VAT Pro Rata Calculations. It's written by Philippe Gamito and it's published in the EC Tax Review Journal. This article is for EU VAT experts. As the title indicates, it considers the impact of the European Court of Justice decision in the Morgan Stanley case in January 2019. Here's a quick reminder of that case. The case concerned a UK bank with a branch in France. The branch incurred expenditure which exclusively related to both taxable and tax-exempt transactions entered into by the UK head office. The branch also incurred general costs which related to both transactions entered into by the branch and transactions entered into by the UK head office. The issue in the case was how to calculate the amount of deductible input tax for the French branch in these two sets of circumstances. The court's decision sets out the calculation methodologies. One of the major issues discussed by the author is the court's use of a so-called double layer test, according to which VAT incurred by the branch will solely be deductible provided that, and only if, it is concomitantly deductible in both member states. The author criticises this approach. From a pure theoretical perspective, the double layer interpretation put forward by the court in Morgan Stanley may be open to challenge. Instead, the CJEU could have applied the letter of the law as laid down in Article 169 of the VAT Directive and applied a one-layer test. Provided that the overseas establishment is engaged in an economic activity, input tax recovery should be allowed on the basis of the branch's domestic rules. Sadly, this approach seems to have been ruled out by the Advocate General and not even considered by the CJEU. Well, that's the way it is this Friday, the 3rd of May 2019. I'm Steve Towers. Have a great weekend.